you plan for this next year's audit and even just are aware of it in general. So jumping right in here, some of the big changes with SARS 21. Now some of you may have been following this already, and so you know that we're in kind of a recodification mode as a profession, if you want to think about it that way. You know, several years ago we recodified all of the FASB standards into the FASB codification. We've recently recodified professional ethics standards. And a couple of years ago, and here's where I'm going to try to draw an analogy, a couple of years ago we recodified the auditing standards. And so we had the clarified audit standards. Most of you who are auditors are aware of that. And what we're doing here with the new compilation and review standards is exactly the same thing, all right? These are the clarified compilation and review standards and a recodification of those standards that supersedes the existing compilation and review standards. And to further the analogy here, you may also remember that when we did this with the audit standard a couple of years ago, there were a lot of changes with the audit standards, but most of them were pretty insignificant. Pretty, we would say non-substantive, right? A lot of wording changes and things of that nature, but only a couple of things that made a big difference to what you actually do on your audits. And in the case of the auditing standards, that was changes to the auditor's report, and of course the big new requirements related to group audits. Well, similarly, we have the same thing going on here. We have recodified compilation and review standards, and there's a lot of little changes, because we've rewritten the language here, but there's only a couple of things that you would consider to be big changes. And one of those is changes to the report, just like we had with the audit standard. So we've got a new compilation report and a new review report and report format. And then also, SARS 21 introduces a new level of service, which is the financial statement preparation service. And we'll spend most of our time in SARS 21 talking about that, because that's what's really new here. If you're like me, you see that and you think, well, wait a second here. I thought a compilation was a financial statement preparation. What is the difference here? And that's what I'll hope to clarify. I know when I first went through this, I thought, what are we really offering here that's different than what we've had before? Some have called this, though, the biggest change to the compilation and review standards since they were issued over 30 years ago. And really, because we are introducing a new level of service, it is that substantial of a change. So just to clarify what we're talking about, going forward under the SARS standards, there will now be 3 levels of service that you can offer instead of 2. Previously, you could do a review or a compilation. Now, you'll be able to do a review, a compilation, or a preparation. So to get into this, let's start with our first polling question. To date, how familiar are you with the AICPA's proposed and now finalized changes to the SARS, including the provision of a new preparation service? Okay, so have you been following this very closely and you know exactly what's going on? That would be response A. B, maybe you've heard a little bit about it, but you've been waiting until they were finalized to really get into the details. Or C, you're just lucky you logged on today because you had no idea anything was actually going on here. So give us an idea of how familiar you are with this first polling question. Remember, you need to answer the 4 polling questions here to get your CPE credit. All right, while we're waiting for most of you to respond to these polling questions, let me talk a little bit about just what we mean when we talk about clarity and the clarified compilation and review standards. They're being rewritten in a format that makes them easier to apply. All right, is really what we're saying here. Now, in my experience, and don't take this wrong, in my experience, most of us who are auditors don't actually read the SARS standards or the auditing standards, and we're pretty good usually at reading like the new GAAP standards, the new FASBs, but we don't usually read these. And so we often rely on a third party, whether it be PPC or CCH or whoever's doing the audit methodology that you're subscribing to actually go through and interpret these and then generate some forms and checklists and things of that nature for us to actually apply. So you may not, I guess what I'm saying is you may not get the effect of this directly All right, but it'll filter through. And the reason it's a little easier to understand is the drafting convention. It states the objectives. It includes a definition sections. It separates the requirements, like what you actually have to do in a compilation or review, from the application and other explanatory materials, because sometimes in the past that that gets a little confusing between those two things. Uses formatting techniques that are easier to read, and importantly, maybe for some of you, it eliminates the SARS interpretations. Now, to the extent those are relevant, they have been incorporated into SARS 21, and of course, if they're not, they're not there, not there anymore. So this is what it looks like now, right? I mentioned that SARS 21 supersedes all of the existing AR sections, well, most of them, other than AR 120. We'll talk about that in a little bit. So we have these 4 sections to the SARS standards now. We have ARC, and notice that little C at the end. Just like, remember when we did this with the audit standards, we went from the AU sections to the AUC sections. Now we're going from the AR to the ARC sections. That stands for the clarified audit review standards. So we have ARC 60, general principles for engagements performed in accordance with statements on standards for accounting and review services. Now I'm really just going to be focusing on the changes here, and there's really almost no change in ARC 60. The one thing that was added in clarity here was that you are required to use professional judgment when you perform a service under the SARS. So if you do a review or a compilation or a preparation, you should exercise professional judgment. All right, hopefully that doesn't change your practice. Hopefully no one says, well, okay, if I got to use professional judgment, I guess I won't do this anymore. So that's a pretty minor thing. Then we have ARC 70. That's the new preparation service, which I'm going to start talking about in a minute. And then we have ARC 80 on compilations and ARC 90 on reviews. And I'll just tell you, very little changes there. So don't be nervous about this. I mean, the way you perform a review or a compilation is really going to be the same before and after SARS 21. The big difference being between whether you do a preparation or a compilation. So let's get into that. So you see we have the new preparation standard here. Let me see if I can tee up here why we even have this, because this is the biggest question I get when I start talking about SARS 21 is why do we have this preparation service? So when the SARS were issued a while ago, over 30 years ago, the compilation standard was written to be submission driven. All right. Meaning you were required to follow that standard and you were required to issue a compilation report when you submitted financial statements to management. Well, when that standard first came out, it was usually pretty apparent when you had actually submitted financial statements to management. For example, and this sounds like it was like 30 years ago, but it hasn't been that long ago since most of us did it this way. But your client would call you and say, we need a compilation, and then they would like print out their GL or their trial balance. You would go pick it up at their office. You would take it back to your office, and you would use your software, whatever software you had, to prepare the financial statements and the related notes. Then you would bind that down. You probably put a little cardboard cover on it, right? You make some copies for your client. You take it back to them, and they would give it to their banker or whoever else they needed to give it to. All right, and so it was very apparent that you had actually submitted financial statements to management, okay? And then, of course, the requirement for a compilation report was simply to make sure that whoever received those financial statements knew what responsibility you were taking for this, so that when your client went to the bank and said, here are the financial statements that my auditor put together, which is usually the way they describe you, that the banker could read the report and know that you actually didn't do anything on this, right? Which is what our compilation report says. Okay, so, but more recently, it's been a little more nebulous about when you actually have submitted financial statements. For example, let's say your client asks you to help them to clean up the books. This is what we mean by, in the bottom right of this slide, kind of assisting with the preparation. They ask you to come in at the end of the year and just kind of clean up the books. So you go there and you book some eliminating entries, consolidating entries, maybe you reclassify the long-term portion of debt, maybe you book the deferred taxes, whatever it is. And you may do that at your client's location. You may do that remotely. You may do that because you have access to their cloud-based applications that they use for their accounting. And then at the end of that, you print the financials. Literally, you just push print. And they print at the client's location. The client takes that and gives it to a banker. So the question is that a compilation, right? Have you submitted financial statements to management? And you know, a lot of firms look at that and say, yeah, that sounds like a compilation. So they slap a compilation report on that thing. Well, let's say you do exactly the same thing, except this time when you're done cleaning up the books, you just log off and leave, and then the client prints the financial statements and they take it to their banker. Is that a compilation? Well, a lot of firms would say, no, that doesn't sound like a compilation. And yet the only difference between the two things you did is on one, you push print, and the other, your client push print. And so we're kind of in this gray area. It's a little nebulous about when you've actually performed a compilation, and so when you need to issue a compilation report. And that's what this new preparation standard is really about. It's going to draw a couple of bright lines. When do I do a compilation and so need to issue a compilation report? When is it a preparation, which does not require a report? And when is it just assisting with bookkeeping or assisting with preparation, which isn't even under the SARS and doesn't require you to follow the standards in the SARS to do that? So with that, this is what we're talking about. So we get into, does ARC 70 apply? We've got a series of slides here. These are taken, by the way, if you want to explore this more, these are taken from an appendix of ARC 70, right, in SARS 21. So what we're trying to do is delineate here between what is a preparation. When have I actually been engaged to perform a preparation, and so I need to follow ARC 70? And when am I doing something else that is outside of the scope of the SARS? Here's the general rule that you'll be able to apply to each of these, and then we'll go through these examples. General rule is this. If your client engages you to prepare financial statements, okay, and that's the main reason you're being engaged, then it's a preparation service. If your client engages you to do something else and you happen to prepare financial statements as a byproduct of that service, then it's not a preparation. It's whatever that other service is. So think about this in terms of, have I been engaged to prepare financial statements, or have I been engaged to do something else and I'm only doing financial statements as a byproduct? So let's go through a few examples. Preparation of financial statements prior to performing an audit or review by another accountant. So your client calls you and says, hey, our auditors are going to come in. We need to give them financial statements. Could you prepare the financial statements so that we can give them to our auditor? Well, that is a preparation engagement. So ARC 70 applies because you're primarily engaged to prepare financials. The next one, preparation of financial statements when the accountant is engaged to perform an audit or review or compilation of such financial statements. Well, in that case, it's not a preparation because you may be preparing financial statements, but you're doing it as a byproduct of your review or your audit. So it's a review or an audit, not a preparation. Next one, preparation of financial statements for an entity to be presented alongside the entity's tax return. So once again, maybe you prepared the tax return for your client or someone else did, and then they say to you, you know, we'd also like to have some financial statements to go along with this because our banker or whoever would like to see our tax return and our financials. Well, you're being primarily engaged to prepare financials, so ARC 70 applies. On the other hand, if you're primarily engaged to perform the tax return and you create financial statements for the purpose of submit the tax return. Sometimes you have to create a balance sheet, for example, in order to submit the financial statements. In that case, that is not a preparation engagement, right? And it's not under the scope of ARC 70 because it's a tax preparation engagement. Preparation of personal financial statements for presentation alongside a financial plan. In this case, this applies. Assuming some other accountant prepares the financial plan, or maybe you did it as part of another engagement, and then you're also engaged to prepare financial statements to go along with that. So let's say your client says, hey, someone did a financial plan for us. We'd love to have some personal financial statements that go along with this. Could you put those together? You say yes, that's a preparation engagement. On the other hand, personal financial statements that are prepared for inclusion in a written personal financial plan prepared by the accountant. If you're the one engaged to do the financial plan, and you do financial statements, let's say personal financial statements, as a byproduct of that, as part of that engagement, that is not a preparation because it's a financial planning engagement. Financial statements prepared in conjunction with litigation services that involve pending or potential legal or regulatory proceedings, not a preparation. It's part of that litigation support. Financial statements prepared in conjunction with business valuation services, not a preparation. It's part of the valuation service. Maintaining depreciation schedules, not a preparation. Preparing or proposing certain adjustments, such as those applicable to deferred income taxes, depreciation, or leases. Not a preparation. Those are all bookkeeping services which are now distinct from a preparation. Preparation of single financial statements such as a balance sheet or income statement or financial statement with substantially all disclosures omitted. Well, in this case, if the main reason I'm being engaged to prepare is to prepare financials, then that applies. And what this is really trying to say is it applies even if you omit substantially all disclosures. You can omit substantially all disclosures in a preparation just like you can in a compilation. That's one of the questions we had a little earlier that I saw come up. Drafting financial statement notes, not necessarily a preparation, right? If you're doing it as part of an audit or something like that, but you're not specifically engaged to prepare financials. Now, I don't know if that made it more clear or not. That's what we have in the appendix to ARC 70. There's a couple others here, but remember, in all these, there's some judgment required between when bookkeeping stops and preparation starts. But the point here is you need to make that determination now, whereas before it was quite nebulous on the compilation standard. Using the information in a general ledger to prepare financial statements outside of an entity's accounting software system. Right? So your client sends to you or downloads for you, whatever it is, their GL, which you take and create financial statements and give back to them. That's a preparation, as opposed to bookkeeping, entering general ledger transactions or processing payments in the client's accounting software system. Not a preparation, even if in doing that bookkeeping you print financial statements that you know they're going to take to a third party. Not a preparation. So that's the first of the bright lines that ARC 70 is attempting to draw here. When is it bookkeeping, and then when is it a preparation? Now, if it is a preparation engagement, there are certain requirements, as you might expect, that you need to follow. Here's the easy way to explain this. The requirements for a preparation are really exactly the same, with just a couple differences I'll point out in a minute, as a compilation. So if you're wondering what is the difference between a preparation and a compilation, so substantially there is none, right? You're going to do the same stuff. So you need to accept or continue the engagement. You need to get a written engagement letter for preparation, just like a compilation. You need to obtain an understanding of the reporting framework. So if it's GAAP, you understand GAAP, or tax basis, you understand taxes. Then, of course, you need to prepare the financial statements. Just like on a compilation, you could do this, financial statements that omit substantially all disclosures. You can do it on a special purpose framework like tax basis or modified cash basis. There are some additional requirements if you do that, though. For example, if you prepare financial statements that omit disclosures, you need to say that on the face of the financials, because there's no report with a preparation, which is kind of the whole point. So the title of the financials would say that itself. It might say something like balance sheet dash substantially all disclosures omitted, or something of that nature. Likewise, if it's a tax basis, then the title of the financial statement should indicate that it's the tax basis of accounting. You need to prepare sufficient documentation to provide a clear understanding of your work, which usually is at least, the engagement letter and the financial statements. Could be other working papers if you have any. And then we get to kind of the kicker here. You need to include a legend on each page that no assurance is provided. So in a preparation engagement, since there's no report, there still needs to be some way to let the user of the financials know that you didn't audit these things. So you put a legend on each page that says no assurance is provided, or something to that extent, right? It could say something like no CPA has audited or reviewed these and no assurance is provided, something like that. And as long as that's there, then there's nothing else you need to do. There's no report that you issue here. Your firm name is not associated with these anywhere. You're simply preparing them for management to give to someone else, and it just says no assurance is provided. If management does not want you to put that legend on the financials for whatever reason, then you have two options. You can either just do a compilation and then issue a compilation report, which would be my suggestion. That would be the easier option. Or you can issue a disclaimer. The disclaimer would look like this, okay? It would say, the accompanying financial statements of XYZ Company as of and for the year ended December 31st were not subjected to an audit, review, or compilation engagement by me, and accordingly I do not express an opinion in conclusion or provide any assurance on them. All right, so it's saying the same thing. There's no assurance, right? It's not even that different than what was in a compilation. So you could issue that disclaimer, or you could just do a compilation and issue a compilation report. But really, from a practical standpoint, I think what you want to do is you want to put that legend that says no assurance is provided, and then if your client doesn't like it, I would just do a compilation and issue a compilation report. I think it's a little cleaner and a little easier to do. the preparation service is not the same as a management use only compilation. In fact, there is no such thing as a management use only compilation anymore. That goes away as part of SARS 21. And the reason it's not the same is because if you do a preparation, your client is able to give this to whoever they want to. This can go to a banker or any other third parties. They are not restricted at all in the distribution of these financial statements. Going down to this last bullet point on this slide, you're required to disclose any material misstatements such as those caused by known departures or inadequate disclosures. So again, in a preparation, since there's no report, you've got to have some way to alert the user that something is not right in here. And the way you would do that in a preparation is you would actually have a footnote that says something like departures from GAAP, and then you would list the material misstatements, all right? In the rare circumstance in which you have material misstatements and you omit all disclosures, then you would actually have to disclose the misstatements on the face of the financials. And don't ask me what that would look like. I actually have no idea. I could think through it and think of it. You'd have a little asterisk maybe and some language on the bottom, but that's probably not your best, best avenue to go down. All right, that's high level what preparation is, which brings us to polling question number 2. Is the CPA required to consider whether or not he or she is independent in a preparation engagement? Now, I haven't mentioned this yet, so this gives me a chance to, I guess, answer the question as I ask it. Is the answer, of course, why would this be any different than a compilation review or an audit? Or is the answer no, independence is not an issue since preparation is a non-attest service? And actually, the answer here is B. A preparation service is a non-attest service. You are not required to be independent to do this. And so you're not required to determine whether or not you're independent. You would probably know. And since there's no report that goes along with the preparation, there would be no report to disclose if you're not independent. So this is different than a compilation in that respect. Non-attest and independence is not required here. While you're finishing that polling question, there's a few items in chat that I'd like to get to. One asks, is the preparation standard subject to peer review? It's a great question. Right now, like today, the answer is yes. However, there is an exposure draft that the comment period ended at the end of October. There's an exposure draft to explore removing it from the scope of peer review. I don't know how to handicap that for you, whether that'll go on or not, or whether it will eventually be removed. But there is an effort now to at least look at removing it from peer review. So you need to kind of keep your eyes and ears open for whatever eventually happens with that. I think that if it is, exempted from peer review, we may see more preparations than we would otherwise. Okay. Someone asked, can you just put unaudited instead of no assurance provided? The answer is no, because reviewed financial statements provide assurance as well, right? So you need to have the statements to be no assurance provided. You can add more language to it than that, but you do need to have that statement, no assurance is provided. Okay. So with that is what's going on with the preparation standard. How does SARS 21 change anything else? And the first thing to jump to is what's going on with compilations. How are compilation engagements changing? Well, the first thing, and this is kind of what we've been talking about, is that compilations are now engagement driven instead of submission driven. So before, when you submitted finance statements to management, you had to issue a compilation, so you had to figure out if you had submitted financials, like we talked about at the beginning. But now you're only required to follow the compilation standard and issue a compilation report if you are specifically engaged to perform a compilation. So what does that even mean? Let's go through a scenario. So your client calls you and says, our bank covenant requires that we issue compiled financial statements at the end of the year. So can you come and put those financial statements together for us to give to the banker? Well, in that case, the user, the banker, specifically requires compiled financial statements, meaning they need a compilation report. So you would perform a compilation, okay? And you would issue a compilation report. On the other hand, let's say your client calls you and says, we have some vendors that would like to see our financial statements before they enter into a contract with us. Can you put the financial statements together? In that case, there is no explicit request for a compilation. The vendors haven't requested a compilation report, and so you would likely just do a preparation. You'd prepare the financial statements, but you would not issue a report, and you would give those financial statements to management to give to their vendors. All right, and so that's the scope of where the compilation standard is applicable has become much more narrow than it was before. Also, we mentioned there's no more management use only compilations without a compilation report. That used to be an option. Now, a lot of firms never did these. A few firms did a ton of these, so it kind of depends where you were. But if you don't want a compilation report, then it has to be under the preparation standard. If it's a compilation, then it always requires a compilation report now. If you want to restrict use of the compilation, you actually have to do that on the compilation report. This does require an engagement letter to be signed by both the CPA management. I'll tell you what, everybody's doing that already. Technically, that's a new requirement because previously you had to have an engagement letter, but it didn't say it had to be signed by both parties. So technically that's a new requirement, but really every firm I've worked with is doing that already. The compilation report is much shorter, and I'm going to show you what that looks like in just a minute. And the report is required to include the city and state where the CPA practices. Once again, that's common practice already. I think everyone is probably already doing that. And the report requires additional paragraphs in certain circumstances. This is true for both compilations and reviews, that there are certain times where you are required now to have additional paragraphs, such as when you use a special purpose framework or when you admit substantially all disclosures from a compilation. So here's what the new compilation report looks like. I'm not going to read the whole thing. We have a lot to get through in under 30 minutes now, but you'll see it's much shorter, right? It's a single paragraph. And just a couple things I'll point out. I mean, the substance of what it says is very similar, so you're going to recognize this. But recognize that how it starts out. It says management is responsible. You know, an audit starts out by saying we have audited. A review starts by saying we have reviewed. But the compilation starts by saying management is responsible. So you can see that ARSC is trying to send a very clear message here about the kind of responsibility we take in a compilation, which is not hardly any. And then at the very bottom, you'll see it says, accordingly, we do not express an opinion, a conclusion, nor provide any form of assurance on these financials. That word conclusion is new in SARS 21. We express an opinion on an audit and a conclusion on a review. And so whenever we talk about reviews, you're going to see that word conclusion now, where we didn't necessarily see that before. And that's really it with compilations, right? Everything's the same except when you actually do it and then what the report looks like. So how are review engagements changing? Well, it's going to be the same type of issue here. Not very much, except for the new review report. So here are some of the minor things, and then we'll get to the report. You need to have an engagement letter signed by both parties, which again everyone's doing right now. It needs to include the report needs to include headings, and in fact, it's going to look a lot like an audit report, as I'll show you. It needs to include the city and state where the CPA practices. Once again, almost everyone is doing that right now. And it introduces the terms emphasis of matter and other matter paragraphs to the review literature. And so the way we think about additional paragraphs on a review is now very similar to the way we think about them on an audit. Now, it's not that it's reviewed, it's not required every time in a review like it is in an audit. For example, if you have a going concern uncertainty, you still are not required to have a paragraph for that on a review like you are on an audit. But in many other instances you are, such as using a special purpose framework like tax basis. You're required to obtain evidence that the finance statements reconcile to the accounting records. As a practical matter, I'll bet all of you are doing this already. If you prepare financial statements as part of your review, then you're already doing this. If you're in the unique situation where the client prepares their own financial statements or has someone else do it and they give those to you and then you just do analytics on it, then you would need to do the additional step of reconciling that back to the GL or trial balance or other accounting records. But for the most part, you're doing this already. It introduces requirements when using the work of other accountants. This is a little more rare, but for example, let's say you're reviewing an engagement that is a consolidated entity, and other accountants audit or review one of the subsidiaries. Then there are additional requirements for you in that situation if you're relying on their work. You need to communicate to them, you need to let them know that you're relying on their report, and you also have the option of referring to them in your review report, similar to the way that you can do that on an audit. Now, just a word of caution here. That's the only similarity between this and like the group audit standard. It doesn't require nearly the amount of things that you're required to do on an audit in similar circumstances, but it does introduce additional requirements here that weren't here before. You're required to accumulate and evaluate misstatements. Most of you are already have like a past adjustments list that you take and evaluate. You need to continue to do that. If you haven't done that, you need to do something like that. And it also clarifies that reviews can be applied to other historical information besides historical financial statements, including components of a financial statement, like a balance sheet or something of that nature. So here is your new review report. Just kind of soak it in here for a minute. I mean, without actually reading any of the words, what does it look like? And it looks like an audit report, doesn't it? We have the same sections and we have the same types of headings. And of course, the conclusion is different, and the details of what we say there is a little different. But the substance is very, very, or I'm sorry, the presentation is very, very similar to an audit report. Okay. What I have on the next few slides is actually this report broken out in more detail. It's not my intent to read that. That would be boring to hear me read through the new review report. It's really just there for your benefit, so that in downloading these slides, you can see what the new language in the review report is. So I'm going to skip those slides, but what I want to point out for you is a couple of things on this slide. You'll see that there's a section that highlights management's responsibility for the financial statements. You'll see that there's a section for the accountant's responsibility. So again, very much like the audit standard. And then at the very bottom, you'll see that it says accountant's conclusion, where the audit report says auditor's opinion. The review report says accountant's conclusion. Much of the language is similar besides what I've pointed out there, all right? But you do need, that is the new review report, when these become effective. I've got a lot of questions on the effective date. I've got a slide coming on that in just a moment. So let me skip these slides, which again I just included for your benefit. And this takes us to polling question number 3. True or false? In a review engagement, under SARS 21 that is, the CPA is required to obtain evidence that the financial statements reconcile to the accounting records. Well, the answer to that is true, by the way. So you've got, I know you've got a few seconds to answer that, however long we leave the polling question open, but the answer is true, right? We mentioned this in the slide. Now, once again, you're likely doing this already. This is almost certainly not a big change for you, but if for some reason you haven't been doing that, then you need to document that evidence, which is usually just having the trial balance in the work papers and showing how they agree to the final financial statements. Okay. So I'm going to ask the question in chat while the polling question is open. Are we required to apply these standards now? And as I mentioned, the next slide is going to get at the effective date. The effective date is actually not until periods ending on or after December 15th, 2015. All right. So if you have a calendar year-end client, it wouldn't be your review or compilation of the December 31st, 2014, but of the December 31st, 2015. That this would be required to be applied. However, early adoption is permitted. So if you wanted to start to use the preparation standard to do preparations, you could do that right now. You could also begin to use the new report formats right now. You can early adopt any of these, or you can early adopt SARS 21 for any of your clients that need that. I'm going to give you a word of caution there, though. Be careful about that. Because while most of this is very, very self-explanatory, whoever's providing your audit methodology, and I'll use PPC as an example because that's who I'm affiliated with, their guidance hasn't come out yet, and so their guidance will come out when they issue the next version of the guide, and that's going to give you more guidance, some more illustrative reports, and maybe address some of the ambiguous requirements in a little more detail. It may simply be safer from a QC standpoint to hold off until the guidance comes from your methodology provider. But having said that, early adoption is permitted, but you're not required to do this for about a year. Okay. Someone asked if they could put, like the firm's name, if they do a preparation, if they could put the firm's name on the bottom of the, the face of the financials, if they wanted the firm's name to be associated with it. You know, I don't know of anything that would specifically prohibit that. I just don't think you want to do that. If it's important for you to be associated with the financial statements, then do a compilation and issue a compilation report. One of the whole purposes of a preparation is to not have to be explicitly associated in the eyes of the user of the financial statements. Someone else has, you know, what happens if you have like one of these evergreen agreements with the client where you provide monthly financial statements like an ACBOA with no disclosures. Okay. Well, you know, since that's an agreement to prepare financial statements, then you would follow at least the preparation standard, and you would need a new engagement letter because the preparation standard requires an engagement letter, and the language there is a little different than what you've used before. There's examples of that language in SARS 21. So be cautious about that. If you have one of those evergreen agreements, if you want to start doing it under the preparation standard, you'll need another engagement letter for that. Okay. Well, that kind of rounds out our discussion of SARS 21. I went through that pretty quickly. I really appreciate the questions I've been getting on that because those help to clarify some things. The next segment, really I guess the last segment of our webinar today, is just highlighting for you some accounting standards that you want to be aware of. Now, these ones relate to private company accounting, and these were all issued earlier in 2014. As most of you, I'm sure, are aware of, a couple of years ago, the Financial Accounting Foundation formed the Private Company Council. The Private Company Council operates, for lack of an easier description for today, operates sort of like a subcommittee of the FASB. And their job is to take a look at GAAP, financial reporting standards, and see if there's any simplifications or streamlining or modifications that can happen to make this easier for private companies. And this is a good thing, right? And the first three of these consensus opinions of the Private Company Council have been approved by the FASB and issued as new accounting standards. So just to clarify, each of these is an option for private companies. A private company is not required to do any of these. They can just stick with GAAP the way it is for public companies and go on their merry way. There's no requirement. But if they choose to, they can adopt all or any one of these or any combination of them for their financial statements. All of these have the same effective date, which is periods beginning after December 15th, 2014. But early adoption is permitted. So for any compilation, review, or audit that you're doing where the financial statements haven't yet been made available to be issued, your client could still early adopt these into that period, regardless of what it is. And also, when your client does any of these things, it's a change in accounting principle. So you want to make sure that there's a footnote on that change in accounting principle, and if it's material, you'll want to highlight that in your audit report as well. But let's just get into, on a high level, what these are. I'm just going to warn you. I often spend an hour or two explaining these standards. So for our purposes today, I just want you to know what's there, generally speaking what it does, so you know if it's something that you want to do, or if you're a corporate accountant, or you need to talk to your clients about if you're a public accountant. So ASU 2014-02 is on goodwill. And what this is this allows a private company to amortize their goodwill on a straight line basis over 10 years. And in some cases, less than 10 years, if the entity can demonstrate that a life less than 10 years is actually appropriate in that circumstance. But they don't have to do that. If they just want to amortize their goodwill over 10 years, that's the basic rule, and they can do it over 10 years. That's prospective. So you don't go back to whenever the goodwill first got on your books and start amortizing it. Rather, in the period that you adopt this, let's say it's 2015, you amortize goodwill prospectively from that date forward until after 10 years, it's off the books. All right. Now, the thing about this is a simplification, right? This is supposed to make things easier. Well, amortizing goodwill is not actually easier than just leaving it on the books and not doing anything with it, which is what you do now under GAAP. So what is the point of 2014-02? It's not really about amortizing goodwill. What it's really about is impairment. It's just that the simplifications for impairment are contingent upon amortizing goodwill. So first you decide to amortize goodwill, and then if you do, you get the benefit of the simplified impairment guidance, which is basically that goodwill would be tested for impairment only when a triggering event occurs. Now that's true in current GAAP, right? if a triggering event occurs now, you have to do an impairment analysis. But under 2014-02, that's the only time you would have to do an impairment analysis. In other words, no more annual impairment analysis of goodwill. That's the main change here. So your client doesn't have to do any kind of annual analysis of goodwill impairment, and you as an auditor or reviewer or whatever your role is don't have to do any kind of an annual analysis or impairment of of goodwill impairment. Now, for some of your clients, that's a big deal. For others, that's not a big deal. So that tells you whether or not 2014-02 is something that's attractive. But it allows you to advertise goodwill and then get rid of the annual impairment test. Now, if there is impairment of goodwill, there's a further simplification, which is that you can choose to evaluate goodwill impairment at the whole entity level instead of just the reporting unit level. And there's only a one-step process instead of a two-step process. In other words, I just would compare the carrying amount of the company to its fair value, and the fair value is less. Then I would just write down goodwill until those two numbers are the same, or until goodwill is zero. And that's a much simpler and more streamlined process than what is currently required in GAAP. All right, that's ASU 2014-02. You can evaluate whether that's something that makes sense for your clients or for your company. The next one is ASU 2014-03 on interest rate swaps. Now, on this one, I'm going to editorialize here a little bit. I think the one on goodwill is okay. I mean, I think that could give some relief to some of your private companies on impairment. No harm in applying that. I think the one on VIEs that we're going to talk about next is actually really good. This one on swaps, I don't think is awesome because it really only gives you a marginal simplification. But let me see if I can explain what FASB is actually going for here. All right. So here's the circumstance that a lot of private companies find themselves in and what this is trying to fix. Take, for example, a private company that goes to a bank to negotiate a new term note. Let's say it's for $5 million. And the bank, approves the $5 million note, but at a variable rate of interest. So the private company says, well, that's great, but I'd really like to lock that in a fixed rate. Can we make it a fixed rate? The bank says, well, we prefer not to do that because your collateral position isn't great or you're small or whatever it is, and if we give you a fixed rate, it's going to have to be really high. So you're better off with this variable rate. The private company says, well, okay, I get what you're saying, but I'm really nervous about the volatility of cash flows that could happen if interest rates start to go up and I start to owe more in interest expense over the next few years. Isn't there some way I can be protected from that? So the bank says, I'll tell you what we can do. We can't lock you into a fixed rate note, but what we could do is sign a swap agreement. The company says, well, I don't know what that means. What is that? The banker says, well, swap agreement is just this. It's a contract whereby when you pay me your interest on the variable rate, I turn right around and pay that same amount of interest back to you, and then you pay me a fixed rate of interest. It essentially converts the variable rate debt to a fixed rate debt. To which the private company says something like, well, that sounds idiotic, but if that's the only way to make this work, sure, let's sign the swap agreement. So they execute the swap agreement. Private company goes back to business. 8 months later, the auditor comes in, and the auditor is reading their debt agreement and comes across this swap. So they go to their client and say, you have a derivative. And the client says, what are you talking about? I don't even know what a derivative is. What is that? And they say, well, a derivative is a financial instrument, and we have to, it's your swap, by the way, and we have to mark it at its fair value and put it on your balance sheet. And then every period, we have to mark it up or down to fair value, and the change in fair value has to flow through the income statement as a gain or loss. The private company says, well, that's awful. I don't want to do that. That's not why I entered into this swap. I just did this to fix my interest. Is there some way we could not do this? To which the auditor says, well, yeah, there's one thing we could do. We could apply hedge accounting. Private company says, what is hedge accounting? Auditor says, hedge accounting is just like derivative accounting. We still put it on the balance sheet. We still mark it up and down to fair value, but only the portion of the fair value that makes your variable interest fixed interest goes through the income statement, and the rest of the change goes through other comprehensive income, and it just sits there until we need it later to make the variable rate a fixed rate. The client says, well, that sounds idiotic, but if that's the only way to make this work, let's do that. And then the auditor says, great, show me your contemporaneous documentation of how you're going to evaluate hedge effectiveness. Client says, I don't know what that is. I didn't do that. Auditor says, well, you were supposed to have written a memo on evaluating hedge effectiveness when you entered into the swap. Client said, I didn't know that. I didn't do it. Auditor says, well, then you can't use hedge accounting. And also, because you have a derivative, you have to disclose the fair value of all your other assets and liabilities. All right. That is this unfortunate situation that private companies have found, that private and public companies have found themselves in when they enter into an interest rate swap. And that's what 2014-03 is trying to solve. So, if this swap meets certain qualifications, which I, by the way, I am not going over as part of our webinar, you'll need to go to the standard for that, because it takes too long to go through them. But essentially, if it's a plain vanilla swap and the notional amount is the same as the principal amount of the debt, and all the critical terms match, I'll leave it at that. If it meets certain conditions, then the interest expense would be the similar as it would be on a fixed rate borrowing. In other words, it's hedge accounting on a perfectly effective hedge. You could measure the swap at settlement value instead of fair value. Now, that may or may not be a big deal, right? If your client just gets a statement from the bank saying what the fair value is and it's immaterial, and so you rely on the bank statement, then this is not a help to you. If, on the other hand, the swap is material, they get the value from the bank, and because it's material, you use a third-party valuation expert to audit the value of the swap, then this could be a big deal, because then you could just record it at settlement value. And settlement value is just discounted cash flows. It's the difference between the fixed rate and the variable rate projected out over the life of the swap, discounted at a risk-free rate, right? Simple. Your client can do that, you can do that, but again, it's only easier if you're spending a lot of time on the fair value now. And the required documentation to qualify for hedge accounting would be required before the first finance statements are issued instead of at inception of the hedge. So you have until you actually issue the finance statements to put that little memo together that the auditor came in 8 months later and said you didn't have. So those are the simplifications on 2014-03. As you can see, it's pretty marginal, but in certain circumstances this might be a benefit for some of your private companies. Then we get to the last one, ASU 2014-07. This one I think is the biggest deal. This one allows that when the arrangement between a private company lessee and a lessor entity meets certain conditions, the private company lessee can elect to not apply the VIE guidance to the lessor entity, which means you can elect to not consolidate the lessor entity if you meet certain conditions. This one is getting at a situation that looks like this. This, I'm sure, is very familiar to most of you on the line, all right? It doesn't have to look exactly like this, but this is what FASB was going for. I've got an owner, which could be an individual or several individuals, a group of owners, or even another entity. And it has a controlling interest, usually through majority equity ownership, in your client, which is a reporting entity, and another company that's a leasing entity. Let's say it's an LLC. And the LLC was formed for the purpose of acquiring a building, which it finances through some capital contribution by the owner and debt from the bank. So the only thing sitting in that LLC, or that leasing company, is usually the building and the debt on the building. And then it leases the building to the reporting company, your client. And the question is, do I have to consolidate that or not? Well, we could take an hour and talk about VIE guidance. We're not going to do that. Long story short, there's tremendous diversity in practice right now. People interpret the guidance very differently as it relates to this scenario. And the reason for that is because when FASB wrote the VIE guidance, they did not contemplate this scenario. So ASU 2014-07 essentially allows the reporting company right there, which is your client or the company you work for, to not consolidate leasing entity, just opt out of VIE guidance altogether. That's an attractive option to a lot of private companies. One other benefit here is, let's say that in the past, reporting entity should have consolidated leasing entity but didn't, and so did a gap departure. Then they could adopt 2014-07 and remove the gap departure because gap would no longer require them to consolidate the leasing company. These are the conditions that need to apply in order to opt out of the guidance on VIEs and to not have to consolidate it. And I won't go through all of them in detail. The most important things are it needs to be a common control leasing arrangement. So both entities are under common control. There needs to be a lease between the two entities. It doesn't have to be formal, okay? It doesn't have to be in writing, but there needs to be a lease arrangement. All the activities between the two entities need to be related to the lease. What all that means is, let's say the LLC up here has two properties, and it's only leasing one property to a reporting entity. But reporting entity is guaranteeing the debt of both. That would then reporting entity's guarantee of the property it's not leasing is activity not related to the lease, and so you would have to apply VIE guidance in that circumstance. And then D is complicated the way it's written here, so let me explain it more simply. If reporting entity guarantees the debt of leasing entity, then the value of the building at leasing entity needs to be greater than the principal amount of the debt. That's all that means, and that's all that fourth criteria is. If you meet those conditions, then your client can opt out of VIE guidance, not consolidate the VIE, and it's still GAAP. There are certain disclosures if they do this. Essentially, to keep this short in the interest of time, because we're just about at the end of our time together, essentially, you would make the disclosures that are required by other parts of GAAP. So related parties, leases, guarantees, anything of that nature would be required to be disclosed as it relates to that circumstance. And that brings us to polling question number 4, which is our last polling question in our webinar today. Under ASU 2014-02, a private company can elect to amortize goodwill over which of the following periods? Do you remember, was it 10 years? Or was it 10 years or less than 10 years if another useful life is more appropriate? Is it 15 years or you don't know? Obviously, I don't know is always an appropriate answer, but the correct answer in this one would be B. It's 10 years or less than 10 years if another useful life is more appropriate. All right. While you're answering that polling question, let me look at what we've got here in our Q&A box. Someone asked the question of, can I discuss further the possibility that peer review may still be required? And then they make a really good statement here. They say, I'm near retirement, and if I can't avoid the cost of peer review, it would save a lot of money. All right, well, congratulations on your nearing retirement, first of all. It may be excluded. There's an exposure draft that is still being deliberated, so a final decision has not been made about whether preparations will be exempted from peer review. However, reviews and compilations will still always be within the scope of those peer reviews. Okay. Someone asked about, what about typing for the client a bank-provided personal financial statement? It's a good question, and that gets a little nebulous, I think. Fundamentally, if you're preparing the financial statements, meaning you're the one responsible for putting them together, then it's a preparation service unless it's part of another service. I suppose you could say if you're literally just an outsourced typist, that's another engagement, but I would see that to be very rare in these circumstances. All right, that brings us to the end of our time together. We got through just about all the content I wanted to. I hope that I was able to say something that was valuable to you. We got a lot of questions on SARS 21. It's a very easy document to read and understand, by the way, if you want to just pull it up and cruise through it. Thanks for the opportunity to be here today, and with that, I will turn it back to our moderators.
Thank you, Wayne. This is Jeff Gramlich again joining back in. We want to thank Wayne and not only his expertise but his presentation style. I think it's very effective in this format and helps us get through some of these more complicated materials. As you can tell from not only Wayne's slides but from his voice, he's very passionate about what he does and very good, so at it as well. So I'd like to thank Wayne. I'd like to thank all of you for joining today, and we will keep the line open just for a few more minutes in case there's another question or two, and then we will close out here in just a few minutes. Wayne, I do see just kind of one clarification. What is VIE?
That
acronym. Yeah.
Sure. It's a little complicated, but essentially it's this. When I talked about VIEs, it stands for Variable Interest Entity. And it just means a type of entity that is controlled based on something other than voting interest. So usually one company controls another company because it owns more than 50% of the stock. But a company can control another company through variable interests, meaning they control it based on something other than ownership. And a company that's controlled based on something other than direct ownership is controlled based on variable interest, which makes it a variable interest entity. And that's what we were referring to in ASU 2014-07.